Generally, when you choose an asset class to invest in, the first thing that comes to mind for most people are stocks. Of course, when you're new to investing, that's what you'll hear most of the time. But there's more to assets than stocks, and there are many other asset classes that are more secure, but don't offer the same kind of potential gains that you get from stocks. This is Intelligentsia, real-life advice for practical and financial goals. What we want to talk about today are bonds, the bond market, and how the bond market can affect the stock market. So let's get to it. Bonds are known as a secure asset class mainly because there's a fixed amount of money that you can earn from it. You get paid through interest payments at regular intervals. It can be a prudent decision for many reasons, depending on your financial goals and risk tolerance. Some examples of why investing in bonds is a good idea are 1. Income generation. Bonds allow you to receive regular interest payments. This comes typically semi-annually or annually. For some investors, this is an attractive feature that allows them a steady income stream that they can just leave there. This is popular among retirees that are looking for a reliable income stream and those that are looking to protect their assets. Think about it like this. If you started investing in stocks at the start of your career, by the time you retire, you'll likely go more into a wealth preservation phase where you wouldn't want to suffer any more hits to your investments due to the stock market's fluctuations. So naturally, bonds are where you'll prefer to get your income due to its stability. Which brings us to our next point. Number 2, preservation of capital. Bonds are generally considered safer and less volatile than stocks. The income they generate is fixed on investment and maturity. That makes them a more stable option for capital preservation as opposed to other assets that pose more risk. While at the start of your career, you'll be able to withstand more hits to your investment, at retirement age, you'll likely be slowing down on investing and instead be preparing for things like enjoying your retirement and paying for other things like healthcare. While initially you'd be investing in stocks when you're younger, the closer you get to retirement age, the wiser it is to diversify into bonds and make sure that you include some measure of security in your investment style. Number 3, diversification. Including bonds in your investment portfolio can help diversify your holdings and spread out risk. Since the stock market carries risk of you potentially losing gains over time due to unfavorable changes in the market, bonds can act as a counterbalance, offering stability for your assets. Because it's fixed and you know what you can expect on regular intervals, it allows you to take on more risk on stocks, knowing that you have a backup when the time calls for it. That being said, you have to let yourself have a measure of risk management in order to know where your money goes and to know how much you can work with. Number 4, risk management. Bonds are perceived as lower risk investments compared to equities. This is because there's less volatility due to the terms being fixed. The fixed income nature and higher priority in repayment compared to stocks allows for a level of risk management in an investment portfolio. Generally, when a company suffers financial distress, the first in line for repayment typically aren't stockholders, but the ones with bonds. So you're afforded a level of security in terms of a guaranteed payment at a regular interval and higher priority in times of crisis. Number 5, hedging against market volatility. During times of market uncertainty or economic downturns, investors often seek the relative safety of bonds. Because you can rely on them more than other assets, you have a protective hedge against other changes in the market, and as a result, you're effectively protecting your investments. Bond prices tend to be less volatile than stocks, and when they go down, investors tend to prefer them over stocks. That said, those are just some reasons as to why investing in bonds is attractive to investors, and making sure that your investments are secure in an asset class is one way of being more financially stable. When talking about changes in the market, there are multiple reasons as to why that would be the case, and since bonds are a different asset class from stocks, here are some potential reasons as to why a bearish bond market can affect the stock market's condition. Number 1, interest rates and borrowing costs. In a bearish bond market, bond prices decrease, causing yields to rise. When bond yields rise, interest rates tend to go up. And when interest rates go up, borrowing costs for both individuals and businesses go up as well, leading tend to reduce consumer spending and lower corporate profitability. All of these tend to impact the stock market in a domino effect of sorts. Because of this, preferences shift towards a more secure and better yielding asset. Number 2. Investor preference shift. When bond yields rise, they become more attractive to investors seeking fixed income and safety. This is because while it's fixed, it also offers more per investment. As the changes become more favorable for bondholders, other asset classes become less attractive as a result. Not only are other asset classes riskier, but since bond yields become better, they wouldn't offer a lot that bonds already do, apart from the potential to earn more. When preferences shift to bonds, most stocks will then be sold off in the market as investors reallocate their portfolios to accommodate more bonds to capitalize on higher bond yields. Think about it like this. You have the option to invest in something that you have a guaranteed shot to make money in a regular period of time, and the market heavily favors that specific investment to produce more while costing less. If other asset classes don't perform as well as this one, then perhaps the market for this asset class would be better off for you since it's more stable and it's in a favorable spot. Number 3. Discount rate effect. Stocks are often valued using discounted cash flow models, which incorporate interest rates as the discount rate. As bond yields rise, the discount rate used to value future cash flows for stocks also increases, potentially leading to lower valuations for stocks. Number 4. Competing investments. Bonds and stocks are often known to be competing investment options. If bonds prove to be more profitable than stocks, investors end up favoring bonds over stocks due to a higher yield and a perceived lower risk. As a result, selling off stocks in the market is to be expected due to a shift in preferences. Apart from that, since a lot of what bonds can do affect the stock market, this can negatively affect certain sectors. Number 5. Economic growth expectations. Rising bond yields may result in increasing expectations for future economic growth and inflation. While this may be good for certain sectors of the stock market, such as cyclicals and financials, it can be a problem for sectors that are sensitive to interest rates, like utilities and real estate. Understand that if you're someone that invests heavily in real estate, they can't function as well under high interest rates. Think about it like this. If real estate firms decide to borrow money from the bank for their projects, due to high interest rates affecting the potential income it can net in, the returns on it are already reduced due to higher interest rates. This impacts a company's bottom line, and if a firm ends up going under, bond investors are generally the first ones to get paid. Number 6. Corporate debt costs. Corporations often issue bonds to raise capital. Higher bond yields mean higher interest payments on existing and new debt, making significant reductions to a company's income. Oftentimes, it leads to decreased earnings and a decline in stock prices of affected companies. It does tend to affect one another like dominoes in the sense that if interest rates are higher, for certain sectors it could mean that most of the income they get go towards the increased interest rates that they now have to pay off. It's important to understand that market dynamics are complex, and the actual impact of a bearish bond market on the stock market can change depending on multiple factors, including the broader economic environment, investor sentiment, and policy responses from central banks and governments. Markets affect each other, and it's important to take note of changes affecting one another in order to know how to allocate your investments wisely. If you've enjoyed this video and found this helpful, please hit the like and subscribe button. We'd like to be able to go alongside you, and we're pumped to have you in our next video. Stay mentally healthy, and let's get financially fit together.